Picture this. It's the early 1980s in Kuwait. In the blazing desert heat, investors crowd into a dusty parking lot shouting bids, waving checks, and making million-dollar deals in the open air. Within hours, people go from middle class to millionaires, and all of it rests on promises written on pieces of paper. But within just a few years, this frenzy would spiral into one of the most catastrophic financial crashes the world has ever seen. Today, we're unpacking the Souk Al-Manakh Meltdown, a wild tale of unchecked speculation, oil wealth, and the dangers of believing the party will never end. In the 1970s, Kuwait was swimming in oil wealth. The oil crisis of 1973 had sent crude prices through the roof, and tiny Kuwait suddenly became one of the richest nations per capita in the world. Money was flowing. Families were upgrading homes, buying luxury cars, and traveling abroad. But with so much cash sitting idle, people wanted more than just saving. They wanted to invest. Here's the twist. Kuwait already had a formal stock exchange called the Borsa, but it was tightly regulated. Not every company could list there, and it was mainly dominated by the elites. And investors wanted more excitement. So an alternative market sprouted up almost organically in the shadows. This was Souk Al-Manakh. By 1979, when Souk Al-Manakh was established, Kuwait already boasted one of the most developed financial sectors in the Gulf, with more listed stocks than any of its neighbors. But after the sharp crash of 1977, regulators imposed strict rules on company listings and trading. In response, many Kuwaiti businessmen began setting up companies in nearby Gulf states and listing them instead on this new unofficial market. Within just a few years, Souk Al-Manakh grew rapidly. At its peak, it hosted around 70 companies, nearly 40 of them based outside Kuwait. Investor enthusiasm was overwhelming. In a single year, the market's capitalization skyrocketed, leaping from just $5 billion to an astonishing $100 billion in only a matter of months. At first, Souk Al-Manakh seemed harmless. It gave people more options, and early traders saw quick profits. But then came the secret ingredient that would supercharge the bubble: post-dated checks. Instead of paying cash up front, buyers would write checks dated months in the future. Sellers accepted them as good as cash. Everyone believed oil money would keep flowing, so no one doubted the checks would clear. This system fueled rapid speculation. Investors bought shares they couldn't actually afford, hoping to flip them for higher prices before the checks came due. Imagine a pyramid of promises. One person writes a check to buy shares. The seller uses that check to buy more shares, and so on.
By 1982, this small market ballooned into a monster. Shares of companies with no revenue, no assets, and sometimes no offices were being traded at astronomical prices. Some investors became paper billionaires. Yes, billionaires. Overnight. Souk Al-Manakh was no longer just a parking lot bazaar. It became the talk of Kuwait. Everyone wanted in. Businessmen, housewives, even students. But here's the problem. The entire system rested on faith. Faith that checks would be honored. Faith that oil money would never run dry. The collapse of the unofficial stock market came suddenly in August 1982. It began when a dealer tried to cash a post-dated check from a young employee at the passport office, only to have it bounce. That single event shattered the illusion of endless wealth. By September, the Ministry of Finance stepped in, ordering all questionable checks to be submitted for clearance and officially shutting down Souk Al-Manakh. The investigation that followed revealed the staggering scale of the crisis. Worthless post-dated checks totaling around $94 billion spread across some 6,000 investors.
The impact was devastating. Kuwait's financial sector was thrown into turmoil, and the shock rippled through the wider economy, leaving deep scars that would take years to heal. By late 1982, Souk Al-Manakh imploded. Post-dated checks worth $94 billion could not be covered, a staggering figure, especially for a small country like Kuwait. To put that in perspective, that was several times Kuwait's entire GDP at the time. The meltdown didn't just wipe out individual fortunes, it sent shockwaves through the entire financial system. Banks suddenly found themselves holding worthless checks. Businesses that had bet heavily on Souk Al-Manakh went bankrupt. Families who had borrowed against their paper wealth lost everything. The Kuwaiti government had no choice but to intervene. They launched a massive bailout program, consolidating banks and restructuring debts. But the damage was already done. A generation of Kuwaitis saw their dreams shattered in a matter of months. For some, it was even more personal. Stories spread of families breaking apart over unpaid debts, friendships ruined, and investors who couldn't cope with the losses. It wasn't just an economic crisis, it was a social one. So, what can we learn from Souk Al-Manakh? First, speculation built on leverage. Whether it's post-dated checks, margin loans, or credit bubbles, it's always a ticking time bomb. Second, financial markets need transparency and regulation. Without them, greed and euphoria can run unchecked, and the crash becomes inevitable.
Most importantly, the Souk Al-Manakh Meltdown is a reminder that, no matter how rich a nation is, no economy is immune to the laws of financial gravity. Easy money and hype can never replace real value. The Souk Al-Manakh saga is often forgotten outside Kuwait, but it stands as one of the largest financial collapses in history, and a warning sign that still echoes today. If you enjoyed this deep dive, hit that like button, subscribe for more financial history breakdowns, and let me know in the comments, what crisis should we cover next? The 2008 crash? The South Sea bubble? Or maybe the dot-com boom? Thanks for watching, and remember, if it looks too good to be true, it probably is.